What is up, everyone? Welcome to a special episode of Traders Accounting Edition. We're going to be talking about taxes today. I've got my man hanging out backstage, Dr. Jerry Allison, CPA. Without further ado, let's go ahead and bring Dr. Allison on the stream. How are we doing today?
Doing fine. How about yourself, Aaron?
I am doing well. Thank you for asking. So, explain to me a little bit about what we will be talking about today in terms of taxes.
Yeah, we're going to be talking about several different options that traders can use to minimize their taxes or safeguard their assets. And we're also going to be talking about a way to maybe get the government to pay for an LLC if you want to set up something like that. So there's a lot of different information in here. But we're going to be looking at all that today.
Got it. Well, Dr. Allison, I mean, I'm sure there's a lot of people out there, not me, but maybe other people out there that lost some money on trades last year that might be able to take some tax losses there. I don't know. I'm sure you know more about that than I do, but I know you've got a slideshow prepared. Do you want me to go ahead and pop that up now and let you take it away?
Yeah, let's go ahead and do it.
All right, let's get to it. And everyone, smash the like for Dr. Allison. Drop questions in the chat. We are live right now, so if we see any good questions, we'll pop them up and direct them to Jerry. So without further ado, let's go ahead and get that presentation pulled up.
Let me back up. All right. Well, thank you very much, Aaron, and I'm very glad to be here today because this is a really nice presentation. We've developed a new presentation. We did a short one for Benzinga here last year, but this has got some new information in it, and it also allows us to talk about some things that we've never talked about before. So I'm excited for this. He is correct. I'm Dr. Jerry Allison with Traders Accounting. I am a tax accountant with them, and been working very heavily and working on all this stuff to make sure that we're keeping up with the current data. So before we get going into this, I do want to have a disclaimer to make our lawyers happy. So what we're going to do here is just kind of go onto a disclaimer screen. To the best of our knowledge, the information given in this presentation is accurate as of today, and tax changes do happen constantly. So make sure if you use any of this information, you should consult with a tax professional. Matter of fact, there's rumblings in Congress that they may start doing something, including eliminating the IRS. We're not going to go that far, but things could change. So make sure you contact somebody before you use this information. The presentation does not establish a professional or confidential relationship between you, myself, or Traders Accounting, and Traders Accounting is not a law firm. So the information here should not be construed as legal advice. Okay, now we've made the lawyers happy. So let's go on, and we're going to start working on our information. But let's give our contact information here. Now, the website for Traders Accounting, we have a very special web link here that we want to point out to you. And I'm going to put this into the private chat. Hopefully you can all see this link. That way you can just click on it because it is a rather long link to actually click upon. But when you click upon this link, it takes you to a free ebook that you can download. And if you read this ebook, it actually allows you to read about some of the stuff that we've actually already talked about today. So feel free to do that, and that would be fantastic if you could read that thing, and that way you've got some information. Our phone number 800-938-9513, and our email is learn@tradersaccounting.com. So what I want to talk about in the presentation here, let's talk about some basic information. Because as a trader, you're trying to make money. You are really trying to do this as a business, whether you realize that or not. The idea is to make money. You've signed up with Benzinga to actually learn how to bring in revenue. Well, there's some things about treating this like a business, and really your mindset should be that you are running a business. So what should we be really looking at? Well, first of all, you should be concerned about cash flow. You're all taking classes, or you're looking at watching seminars, you're watching all kinds of things to try to help yourselves earn more money, basically trade better. And that is typical with business owners. They try to increase their revenue. But one thing that business owners neglect is the cash out. They don't think about the cash going out. They just think about the cash coming in. And so I want you to think about cash going out. And one of those things going out is taxes. And there are also expenses that are going out. So we want to be able to come up with strategies to be able to use those for our benefit. Now, here's a problem that a lot of people come up with is that you don't want to make financial decisions based you want to make financial decisions based on your business needs, not on the tax code. I've had clients all through the years. I've been doing this for almost 30 years. And I've had clients come up to me and say, I want to buy this big old piece of equipment. It's going to cost $20,000. Let's say, okay, you're going to get $6,000 back in a refund, but what are you going to do with that piece? Well, it's just going to sit there. No, don't make decisions based on the tax code just to get a refund. If you're going to make an expense, it needs to be justify itself. It's got to be able to bring in money for you. So, for example, the courses you take help you bring in more money. Your computer, your internet, your subscriptions to maybe software and things like that. Those help you bring money in. Don't buy something or spend money just for the sake of getting a tax deduction. It will mess you over every time. Okay, so be serious about treating this like a business, and we're going to talk about strategies about doing that. But you also need to be aware of all your tax and protection options. These are critical nowadays that you be aware of these things and what you can and cannot do. And there's a lot of dis and misinformation out on the internet. I do encourage people to read. Matter of fact, one of the things that you should be familiar with is publication 550 from the IRS, because that has all the information about any type of investing, dividends, interest, bonds, stocks, options, futures, everything's in there. That's a long publication. You can just go to the IRS website, irs.gov, and type in the search bar publication 550 and download it. That's one thing I encourage you to have on your desktop of your computer. But you can read other things, but just be careful and weigh everything to make sure that you're getting good information. Well, what we're going to be looking at are some of those tax and protection options. And the first thing we're going to look at is trader tax status and how that can help you. Now, this is for all traders. It doesn't matter what you're trading. If it's Forex, if you're trading futures, you're trading crypto, stocks, options, it doesn't matter. This trader tax status could apply to you. We'll talk about that first. And then we're going to talk about entities. You may have read how it may be beneficial to form an entity to do in which to do your trading. And we'll talk about the benefits of those and what can happen, and even really how to get the government to pay for that entity. And I'll show you how to do that. And then finally, we're going to talk about the stock mark to market election for stock and options traders, how that benefits you, how to make that election, and really the things that can save you there. So let's go ahead and get into this. We're going to start off with trader tax status. Trader tax status is actually a choice. It's not an election. It's not something that you have to fill out a form with the IRS. It's a choice. You can do it or not do it, one or the other, but allows any entity, including individuals, to deduct trading expenses, provided the criteria are met. So how nice would it be to be able to deduct your trading expenses? The course for belonging to or going to a seminar, or the cost of joining a trading group, or having the subscriptions that you have for software or whatever, being able to deduct those on your tax return. That would be awesome to be able to get some of that refund back. And that increases or decreases your cash flow out. So we want to actually be able to take advantage of that. Well, what are the criteria? Well, I mentioned a little bit ago about publication 550. Publication 550 does talk about trader tax status, and it talks a little bit about the qualifications. The qualifications, though, are very vague in publication 550. And I think the IRS purposely does that so they can do the gotcha thing. But anyway, the qualifications are very vague, and so we have to rely on our taxpayers who got caught by the IRS taking it to court. And so what we have to look at are court cases where people have won or the court has set up specific guidelines for that. So these are guidelines where we know people, where the courts have actually set boundaries. Now, in order to qualify for trader tax status, then we have to, first of all, there needs to be at least 700 trades per year. Now, what's considered a trade? Well, if you buy something and then you turn around and sell it, that's 2 trades right there. If you buy it and somehow it ends up being, you buy it in lots, let's say 5 lots, that's 5 different trades right there. So it's broken up in the most beneficial way that it can be, but you have to have at least 700 of those a year. And some of you may be saying, well, what if I don't have 700? What if I've only got 500? And the answer to that is we don't know. There are no court cases where individuals have won on anything less than 700. So we don't know. It's something that if it's a risk that you're willing to take, then go ahead and do it. And if you get caught, if you're willing to take it to court, that might be a case that we can use to actually justify something lower. The second criteria is you have to be trading in over 75% of the trading days per year. So, there's 200 something trading days. So you're going to be trading 3/4 of those, probably 170 trading days or so per year. Now, the concept here, if you go back to publication 550, is the IRS wants you treating this like a business. If you set up some other type of business, like a restaurant or something, you're not going to go and work the business for a month and then take a month of vacation off. You're going to treat it like a business. You might take a couple weeks off, maybe a couple times a year or something, but you're going to be there. And so the idea here is the IRS wants you being fully invested into this thing. You can take some time off, but they want you there quite regularly. There's a third criteria that's come out of the court cases is there has to be over 500 hours in trading, research, and education. Now, this can be split up. It kind of averages 4 to 6 hours a day. And notice that it's not just trading, but any research you do. If you attend education classes or seminars, that time also counts. Now, some of you may be asking, well, how do I prove that? Well, the first two, the 700 trades per year and trading in 75% of the trading days per year, you can hand the IRS your monthly statements or even your 1099-B, and you can prove those two. That's quite easy to prove. The last one, the 500 hours in trading, we suggest that maybe you keep a log every day or whenever you're doing something regarding trading so that you got your log there. Doesn't have to be a physical log, could be an electronic log on your computer. But keep something so that if the IRS ever does come in, you can just hand them that log right there and say, there's my time, you figure it out. And in most cases, they'll probably just ignore it in that case and leave you alone. Now, one thing here, the tax savings here that we're mentioning as far as deducting these expenses, they depend upon your current tax bracket. If you're in the 37% tax bracket, you're saving 37 cents on the dollar. And that's the federal tax rate. You can add your state tax rate if you have one to that. And that's how much you'd be saving. If you're in the 24% tax rate federally, then you're only saving 24 cents on the dollar. But it's still worth something because you can take that refund that you're getting and put it back into trading or pay for something else, as we're going to talk about in a little bit. Now, trader tax status, as I said, is a choice. This is something that you choose to do. But we've got to be very careful here about how we do it. When individuals do this, they actually report the expenses on the Schedule C of their tax return. So an individual trader who's wanting to deduct expenses for trading does it on the Schedule C of their tax return. Now, other businesses, they just do it on the tax return, whether it's a partnership return, an S Corp return, or C Corp return. They just do it on the return. But there's a warning here. A person, an individual deducting trading expenses on their personal tax return must use the Schedule C, as I just mentioned a little bit ago. And here's the following issues that occur. One, the audit risk is increased. You are increasing the probability of the IRS noticing you. And the reason for this is anytime what you're putting onto the Schedule C are what I call unverified numbers. Now, like your W-2, you get a W-2 or 1099-R. Those are verified numbers because the company sending out the W-2 or the 1099-R, they've sent that to the IRS. The IRS has those numbers. So if your numbers on your tax return agree with their numbers that they've got, they're going to leave you alone. But on the Schedule C, you're putting numbers on there that aren't verified by the IRS. They don't know about those. And so those numbers can be a target. And quite frankly, Schedule Cs have been a target for a long, long time. Not because of traders, but because people have abused it and because the numbers are unverified. So that is something that you have to be aware of. If you're going to deduct expenses on your Schedule C, you have to accept the fact that you have an increased chance of being audited. Secondly, excuse me, if you use the Schedule C on your personal tax return, there is no home office deduction. Now, you may read on the internet that there is, and there's other people going out there giving lectures and things like that. Oh, yeah, you can actually do that on your Schedule C. Here's what happens. On a Schedule C, it's a small business return is really what that is. And at the top of it, you've got income. At the bottom of it, you've got expenses. Well, the expenses, that's fine. We know we're talking about trading expenses. The problem with traders is that income part because traders have gains and losses. They don't have earned income. And so the gains and losses are reported on Schedule D. So there's nothing on the Schedule C. And there's people out there saying you can reclassify that. I don't believe that. That's like saying I got a W-2 and I'm going to reclassify it as long-term capital gain so I can get the 20% tax rate. Don't do that. That'll get you in some trouble. So you got the income on your Schedule D. On your Schedule C, you've got these expenses. So the net profit for a trader is always negative. You always have a net loss, period. Well, here's where I'm going. The home office deduction cannot be taken anytime you have a net loss. It just carries forward. Well, traders never ever have a profit. And so that home office deduction just keeps getting carried forward further and further and further, and you never get to use it. So that's another problem with the Schedule C. We'll come back to the home office deduction here in a little bit. There may be no asset protection also. If you create a trading business on your tax return and you use that Schedule C, then there is no real asset protection. So if you get sued personally for maybe a vehicle accident or you happen to slander somebody or whatever, they just don't like how you look. And if the person suing wins, then they have access to all your trading assets. And so you don't want that. So that's a problem there. Number four, it's difficult to justify having a W-2 job and being an active trader. Now, here's one where the IRS has a problem. I don't have a problem, but they do. And then we have to actually kind of work around that a little bit. People have two jobs all the time. I've had them. You've probably had them. Two jobs. We do what we need to do. And matter of fact, the IRS doesn't blink an eye if you've got two W-2 jobs. But for whatever reason, they have an issue if you've got a W-2 job and you're a full-time trader. It's a problem. And so it becomes a target, a little bit more of a target in that case. And so we have all these problems with being an individual trader and deducting expenses on our Schedule C. And if you've got a W-2 job, you've got an additional problem. So how do we solve some of these? Certainly you can do this. I mean, it's perfectly legitimate. We've got clients who do it, not a problem. But it's like rolling craps. Eventually you're going to roll snake eyes and they're going to want some information on what you've got going. So what do we do about it? Well, entities are the answer to this. Now, there's several type of entities: sole proprietorship, single member LLC, general partnership, limited partnership, multi-member LLC, S corporation, LLC S corporation, C corporations, and LLC C corporations. Okay, that's a lot of them. We're going to weed some of these out. Matter of fact, we're going to limit ourselves to LLCs here in a minute. So, but the first two types are the sole proprietorship and the single member LLC. Now, both of these, neither one of these does much for a trader. When I was describing an individual trader business and using the Schedule C, I was describing a sole proprietorship a little bit ago. You just put it on Schedule C and you're done. A single member LLC doesn't do anything else for you. Matter of fact, it gives you some asset protection, but it puts it right back on the Schedule C of your tax return again, where you don't want it. So we need to get everything off your personal tax return. We need to get everything away from that Schedule C so that it's not on your personal tax return. So these two, don't even think about a single member LLC. I have clients coming to me say, "Hey, I formed a single member LLC." I said, "You need to change it, or we need to do something about that, because it's really not a, it's kind of a problem if you just leave it as a kind of like a sole proprietorship." Now, the type of entity that we're going to talk about that's right for you depends upon your situation. It's possible that, in a lot of cases, LLC partnerships are good for a lot of people to start. But you may need an LLC S corp. You may need an LLC C corp, something like that. And I'll explain this stuff as we go along. But if you really want to decide this, it's a good idea to get a lot of information and talk to somebody about it so that they can help you decide what's best for you. Uh, and we'll go through this as we come along. So, why a multi-member LLC? There's a couple reasons for doing a multi-member LLC. Now, again, remember a little bit ago, I said we don't want single member LLCs because that generally, the default, that puts it right back on the Schedule C of your tax return. We got to get it off your tax return. Get all this trading stuff away from your personal tax return. So before I go to the pros of a multi-member LLC, let's look at the cons. There's two of them. You do have a yearly multi-member LLC fee, and you've got a tax prep fee generally, because now we're talking a separate tax return, which frankly is what you want because you don't want the Schedule C. Those are your alternatives: Schedule C or another tax return. So those are really it. So those are the cons. And depending upon the state, it depends on what your LLC fee is. Some states that's negligible yearly. Matter of fact, Arizona, once you pay the setup fee, there is no yearly fee. There's a couple of states like that. Tax prep fee, again, that depends upon who you get to do it. But we'll give an example here in a little bit. So, but let's look at the pros of a multi-member LLC. And by the way, multi-member means you need some type of partner. For those of you who are married, you already got your partner built in. If you're not married, you could get a family member that maybe would take 1% of the business and you still get 99% of the business. You don't like that? We can set up a family trust, an irrevocable trust, where like 1% of the profits on paper go into the trust, and you got your second partner. There are also other elaborate things that we can do. We can get it done. We can build this multi-member LLC, quite frankly, just about with anybody, quite frankly. Now, let's look at the pros of having a multi-member LLC. First of all, you get asset protection. With an LLC, you have some asset protection, and depending upon the state you're in, you can have a lot of asset protection. So that may be worthwhile. Some of you may have some estate, or not states, but trusts in that you already that give you that asset protection. Fine. But this is just another layer, if you will. And for those of you who don't have trusts, it could work for you. Second of all, this is something nice about LLCs, and it doesn't matter whether it's a single member LLC or a multi-member LLC. You get to choose how you're going to be taxed. For example, with a multi-member LLC, if you don't choose anything right away, it defaults to a partnership. Okay, simple partnership. And that's quite frankly where most of our clients go because it is a very, very simple way of doing things. You can pull money out, you can put money in, no tax implications there. It's really very simple. It's just a simple partnership return and everything flows smoothly. However, later on, if we find out there are needs arise, we can file an election with the IRS to say, hey, this LLC wants to be taxed as an S corporation. IRS says fine. So now the LLC, multi-member LLC is being taxed like an S corporation. A few years down the road, I don't like the S corporation. I want to go back, revoke the election. And we're not changing the name of the business. We're not changing the EIN. We're just changing how it's being taxed with the IRS. Nothing on the state side changes. Or if you want to choose to be taxed as a C corporation, that can happen as well. And you can change this quite frankly at will. It's got to be done at the beginning of a year, but you can change this based upon tax code. If they change the tax code so that one of these three is a favorable tax structure, then we can file an election and you get taxed like that. So LLCs are fantastically flexible in how they're going to be taxed. Um, Number three, with an LLC, you have a multi-member LLC, you have a reduction in IRS scrutiny. Remember, I mentioned a little bit ago that you use that Schedule C on your personal return. That just really kind of, it's not a red flag per se, but you were going to get noticed eventually. Once you get that off your personal tax return, it looks like, and I hate to use the word, a legitimate business. And so you have a partnership or you have an S corp or C corp, and it looks like a normal, regular business, and the IRS tends to leave it alone. Um, I, we've seen clients being audited on their Schedule C businesses before, and the IRS wants to know about certain numbers on there, and not on their trading, but on some other Schedule C stuff they've had. We've seen that before, but we haven't seen too much of the IRS interest in businesses, as in the off return, the off individual return businesses. Now, let me talk about something here about IRS scrutiny that has come up in the news lately. If you remember back about a year or so ago, Congress passed a bill that allowed the IRS 87,000 more revenue agents. And at the time, a bunch of people started screaming, well, they're going to just start auditing everybody. And the IRS came out and said, no, 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 we're going to take those people, we're going to use them for administration, and that we're going to audit the rich people, and we're going to audit these big corporations. Well, I read an article here within the last few days, actually, where Syracuse University did a study on the IRS and who they were auditing. The IRS is not going after big corporations, and they're not going after rich individuals. They're going after middle class. And I've been telling my clients this for actually months now. I said the IRS is going to go after the low hanging fruit. Why would they take IRS auditors and lawyers and bunch them together to go after maybe a couple $1 million that a corporation might have, and have the corporation tie that up with their lawyers for several years? Why not go after the low hanging fruit of people who can't afford lawyers? So an auditor or examiner can send out a notice to somebody, say, hey, you owe us $1,000, $2,000. Takes about an hour of the IRS time. The individual generally cannot afford a lawyer or can't afford somebody to fight that, and so they just pay it. And so that's the IRS becomes much more efficient when they start doing that. So that's why I really heavily this IRS scrutiny, really look at this IRS scrutiny thing, because y- you could have the cleanest return in the world, but if an examiner comes in there and decides they want to assess something, what are you going to do about it? There's really not much you can do unless you want to fight it, and then it's going to get expensive for you. So getting this stuff off into a multi-member LLC really does take care of a lot of that scrutiny. You don't have that anymore. Number four, the multi-member LLC actually opens up the home office deduction. I explained a little bit ago how you cannot take that on a Schedule C of your personal return. but you can take that on a partnership or an S corp return. You can put it right on the business's return itself, or you can put it onto your personal return on the Schedule C, where this, or not C, but Schedule E, where this stuff goes as an unreimbursed partner expense. And you get your home office deduction. Now, you say, well, it doesn't matter. That's probably not a whole lot. I could almost guarantee that most people, I can get $1,500 to $2,000 in home office deductions right away. Because what we do is we take the square footage of your office divided by the square footage of your living area. That gives us a percentage. And then we can write off a percentage of your mortgage interest and real estate taxes if you own. We can write off a percentage of your rent if you rent. We can write off a percentage of your insurance. We can write off a percentage of your utilities, HOA dues, repairs and maintenance, anything that goes into that living area. So that's not difficult to come up with $1,500 to $2,000 at least in home office deduction. Now keep that in mind here because I'm going to come back to that. Number 5, it solves the W-2 trading issue. I mentioned that this is a problem with Schedule C people who are doing this to trading business on their personal return because the IRS doesn't like you having a W-2 job and having a full-time trading business. They just don't like it at all. So by getting this stuff, your trading stuff off your personal return onto a partnership return or an S corp return or even a C corp return, it solves that issue because now it looks like you're investing in this other business, but you still have your full-time job, W-2 job over here, but you're investing in this other business, and it makes things a whole lot cleaner. Matter of fact, what it does, it gives you a verifiable personal return. Remember I talked about verifiable expenses, your W-2 is verifiable because the IRS already has a copy of it. Your 1099 Rs, verifiable. The IRS already has a copy of it. If you file as your trading business as a multi-member LLC, let's say a partnership return or an S corp, you get a K-1 from that to put on your personal return. Those are pass-through entities. You still get that stuff on your personal return. However, that becomes verifiable because that stuff is sent to the IRS already. So now your personal return has W-2s that are verifiable, 1099-Rs that are verifiable, K-1s that are verifiable. You just really solidified your personal return. Now, if they want to go after a business for whatever, maybe issuing incorrect documents or whatever, they can do that, but it's, in my experience, it's highly unlikely that they're going to. Number 6, this one, it solves the mark-to-market long-term, short-term dilemma. Now, we haven't talked about the mark-to-market election, and we will do that here in a little bit. The mark-to-market election is for stocks and options traders, but mark-to-market, that election only works really for short-term trading. And if you try to do the mark-to-market election as an individual, then the IRS looks at that and says, oh, you've got long-term stock, you got short-term stock, we're going to lump it all together, and then you're going to owe tax on the gain for the long-term portion. Now, they will try that. Now, there's ways to get around that, but really the best way to do it is separate your long-term and your short-term stuff. Keep your long-term stuff on your personal side, put your short-term stuff into the LLC. And that's about as separate as you can get. And you make the mark-to-market election on the business side, the LLC side, not on the personal side. Now, those are the 6 main reasons for forming a multi-member LLC. We can do it with anybody, but there's one more that I want to explore real quick. The tax savings through a multi-member LLC can actually pay for the multi-member LLC. Because remember, you got those 2 extra expenses that are at the top of that slide, the yearly multi-member LLC fee and the tax prep fee. I have devised a way of calculating based upon your state's yearly LLC fee and the tax prep fee, how much you'd have to have in other expenses actually to pay for those. Let me give you an example. If you already have yearly trading expenses and I'm talking about other than the LLC fee and the tax prep fee, but other trading expenses that could be margin interest, it could be dues and subscriptions, it could be seminars, webinars, education, uh, home office deduction that opens up for the MMLLC, all these expenses. If you have enough of those, the refund from those will pay for the LLC fee and the tax prep fee. Here's the example. Assume a person lives in South Carolina. I had to pick a state, so I did. I just picked South Carolina. The yearly LLC fee is $110 per year. And let's say the tax preparation fee is $750. So a total of $860 each year in extra expense for the LLC. Okay. Now assume the person's in the 32% federal tax bracket and the 6% South Carolina tax bracket. So they're getting taxed at a rate of about 38%. Okay, here's our situation. So we've got extra, if this person forms an LLC, they got an extra $860 in expenses. Their tax bracket is 38%. This person needs at least $1,404 in trading expenses to get the government to pay for the LLC in refunds. So if you have the $1,400 in expenses, remember margin interest, how much did you pay to become part of Benzinga? Home office deduction. Remember, I said there's $1,500 to $2,000 most people can take. That pays for it right there. So you don't believe me? Let's prove it. Let's go through a proof of this thing. So remember here, our trader has $860 in extra LLC expenses for the tax return and the LLC fee, and has a tax rate of 38%. Also, we calculated that if they have $1,400 in trading expenses, the refund will pay for the LLC. So here's what we got as far as expenses. Your total deductible expenses, the $860 in the LLC fee and tax prep fee, plus the $1,400 in other expenses is $2,264. Okay, that's going to be deducted on your tax return. Now, when it gets deducted on your tax return, it's going to be deducted in this case at the 38% tax rate. So you would take 2264 and multiply it by the 38% tax rate, and you get a tax savings of $860, which is the LLC expenses. Remember, the yearly fee plus the tax prep fee. In other words, you're paying for the LLC through the refunds. And what's interesting about this example, and quite frankly, it varies with each state and tax bracket. So we have to calculate this for you individually. But remember, I said that in home office deduction, you can get up to $1,500 to $2,000. That would pay for the LLC right in that case. And that home office deduction, you can't even get that on the Schedule C. So in that case, the LLC would just pay for itself, quite frankly. So that is a huge thing. If you want to talk to us about this, we can actually find out. You let us know what your tax bracket rate is, and also we could look up the LLC fee for your state, and we can calculate how much you'd have to have in extra expenses. You'd have to set up an appointment with me, but we could actually make that happen. All right, let's move to the mark-to-market election. Now, mark-to-market election is only for stock and options traders. The Forex people can't use it, and really don't need to. If you're doing futures, you're not going to be able to use it with that. Crypto, there's a bit of a debate there, but really we're going to leave that alone. So this is an election with the IRS for stock and options traders only. Any business entity, including individuals, can make the election provided the trader tax status qualifications are met. Remember, those qualifications are 700 trades a year, trading 75% of the trading days per year, and having 500 hours in trading, research, and education. So what does this mean? Well, what the election does, it eliminates wash sale losses. Now, some of you may not know what wash sale losses are. If you make a trade, and let's say you've got some type of security, doesn't matter whether it's a stock or an option, and you sell it at a loss. and then you buy anything back within that ticker symbol. Doesn't have to be the same option. It could be the stock. It could be a different strike price, different under options. It could be different. It could be a call, it could be a put. Doesn't matter. As long as it's in that ticker symbol, then the loss on that first sale moves to the second one. Okay, that doesn't sound like a big deal. But if you got a lot of trading going on, these losses keep moving down the line, and they eventually, some of them are going to cross that December 31st barrier. And so let's say you've got $4,000 in wash sales that cross December 31st. Let's say in 2022, they cross over to 2023. You're now going to pay taxes on that $4,000 in 2022, hoping to get that money back in refunds in 2023. But here's one of the problems, and it's very subtle. The IRS, in postponing these losses and you paying taxes now, when you pay taxes now, very often you're going to pay tax in a higher tax bracket. Let's say 35% tax bracket. But when you get to deduct those losses next year, you might be in the 31% tax bracket. So the uh, net between the two taxes, you end up paying the IRS about 4% is really what happens. And I see that happen over and over again. The mark-to-market election gets rid of the wash sales. You don't have to worry about those. Now, it's a little more complicated than just taking your 1099B and saying, oh, the wash sales are gone. I'm going to use the numbers here. You can't do that. Um, the mark-to-market election values things differently. So that's another discussion right now, but the 1099B section that you get from your broker no longer matters. It can't be used. So, but it does give you a more legitimate picture. Basically, if your account goes up, you pay tax on that. And on the other side, the downside, if your account goes down, you get to write all that off because mark-to-market election eliminates the $3,000 loss limitation. Under normal accounting rules, if you have a capital loss, let's say, I was trading in 2022 and I lost $20,000 overall, I can only take 3,000 on my tax return. I got to carry the 17,000 forward to 2023. And again, that same tax bracket problem. You end up paying taxes this year, probably at a higher tax bracket. And then next year, when you get to deduct the 17,000, if you have some other gains, you're going to do so as a lower tax bracket. But anyway, so instead of doing that with mark to market, you get to deduct the entire loss in a single year. And for 2021, I saw people deducting $200,000 in losses on their tax return. And so it's really a good thing for protection on the downside. Now, the mark-to-market election is an election. It has to be made to the IRS. Now, unlike trader tax status, that's a choice. You get to do that anytime you want. Mark-to-market is an election that has to be filed with the IRS at the beginning of the year. For individual taxpayers and C Corps, that has to be done between January 1st and April 15th. For partnerships and S corporations, it has to be done between January 1st and March 15th. There is one exception. New entities can elect it immediately. So for example, you're going along this year, 2023, and you're trading in your personal account. And let's say in July, you thought, well, I really want to set up an LLC. I want to get this thing going. You set the LLC up. The LLC at that point can elect mark to market. So the first part of the year, it's still under your personal account. There's no mark to market. But the second half of the year, if you form that entity and elect mark to market, then everything after that. So new entities get to do that immediately. This is a great tax savings plan for those of you trading stocks and options because it really is a picture of you pay tax on really what you made in the account and you get to write off everything that you lose if that's the case. All right. So let's kind of look at a summary of what we've got here, takeaways. First of all, trader tax status allows you to deduct trading expenses if you qualify. Certainly anybody can do that. So you deduct those expenses on your Schedule C. If you're an individual trader, you can deduct them and through an entity if you want to do that. Fine. Forming an LLC provides asset protection, decreased audit scrutiny, and it could be free to you. Basically, you can get the increased in deductions that you get could possibly pay for your LLC fee and your tax prep fee. So there are definitely advantages there. And then finally, the mark-to-market election allows stock and options traders to pay real tax, legitimate tax on what was really earned, not this wash sale deferral stuff, and write off entirely what was lost if necessary. So mark-to-market is great for stocks and options traders. Rarely that I advise people not to do it. Now, there are cases where I advise people not to do it yet. And we won't go through that right now for the sake of time. Now, before we close up here, do want to go back to our contact information, and Michael's going to come back on here in a little bit. And certainly you can put any questions you've got in the comment section. We'll be happy to answer those. But our contact information, our website is that link there. I already put that into the comments section. If you click on that or you cut and paste it into your browser, it will take you to where you can download a free ebook with everything I've talked about and then some as well. So there's no cost or obligation there. Feel free to go and download that to your computer. If you want to set up a consultation with us, call 800-938-9513. Crystal will answer the phone and she'll set that up. If you want to start an entity, we can do that. Our business manager, Raven Johnson, has been setting up entities for over 20 years. She can do it. She can get it done fairly quickly. But to talk to her, I would caution you, though, do not call the number and ask for me because there's so much going on that I'm doing right now with webinars and with tax returns and things like that. My time is very much protected. So if you want to set up an appointment with me, that's fine. We can do that. But if you just want to talk to Crystal, find out maybe what it's going to cost, she can tell you that. She can also set up an appointment with Raven, who will talk to you about your entity choices and what you could possibly need. And certainly the email learn@tradersaccounting.com. So I'm going to have Michael come back into the picture here, and I'm going to stop sharing my screen, at least that part of it. And so if you guys have any questions whatsoever, feel free to put those into the comments section. But this is something that you really need to learn about. And I'm not saying take my word for it. I'm saying go out and do your research. Learn about this stuff. And when you're comfortable, then pull the trigger. Just kind of like stock and options trading. You got to do your research and you got to have a plan there. And I want you guys to do that. So, Michael, how's that going?
Jerry, what a pleasure, man. Amazing information there. I know, I think last time we had you on, it must have been closer to the end of last year. And we
It
didn't get to
was.
get through your whole presentation. It was obviously a little bit shorter. The full breadth of information you were able to bring out here, phenomenal, phenomenal education. That was really, really good to listen to.
Thank you. It is, and we've added to it, and there's just so much there. I could talk probably for another hour on it because there is so much there. But I want your listeners to say, or at least get advice. Get advice on stuff. Make sure you research it. Make sure you know what you're doing before you pull that trigger.
Absolutely. And I think really the best part of this and why it's such a pleasure to have, you guys on the stream and talking about, the education that you bring to the markets is that a lot of these traders, I think, get so involved with what they're doing throughout the year when you're
Hmm.
on these trading journeys and we're going through streams every day and we're looking at information. And obviously the fantastic audience that we have, part of the
Hmm.
Benzinga family that comes in every day, it's a lot to think about and focus on and research every single day. So when it comes down to something like taxes, I think that's one of the things that might get pushed off to the back of your mind, right? You're not thinking about it as much. You're not really prioritizing it. And with you guys giving
Yeah.
us the information you have, it makes it easy. So I think that's probably the best part of this.
Absolutely. I agree with you 100% on that. And this is actually the time of year where I start talking or doing consultations with people saying, oh, no, it's now 2023. What can I do for 2022? And I have to say, there's not a lot you can do right now. We should have been having this conversation 2-3 months ago. So now start thinking about it now. There are some things we can do for 2023 because now's the time. But don't expect much for 2022.
Absolutely. Well, Jerry, like I said, it was an absolute pleasure having you guys on here once again. We can't wait to distribute this as well. We're going to get this out across all of our taxes and investing kind of information on benzinga.com. This interview is going to be available for anybody who wants to come back and see it later at a different time. But Jerry, Allison, always a pleasure to talk with you guys. Thank you so much for bringing what you guys know to the channel, and we'll see you guys next time.
All right. Thanks, Mike. I appreciate it.